Welcome back to another episode of Investing Explained. Here's today's question.
All right, so you're talking financial ratio here, the price to the sales. So for anybody who's listening to this and they're not, in depth into accounting, sales is your top line number. So if I sell a can of Coke for $1, my sales number is $1. It's not, when you talk net income, that's after you'd subtract out what it costs to pay all the employees, how much it costs for the sugar, how much it costs for the can, and maybe at the end you'd be left with 10 cents out of the dollar sale. The 10 cents is your net income. The sales, or the revenue, as it's called, is your top line, and it's just the whole number without any expenses subtracted out of it. Kais's question here is saying, if the stock is trading for $10 and the company had $10 in sales, that price to sales ratio would be 1.0. He's saying, what's the significance of this? So now that I've kind of described, what those numbers mean for the audience, I'm going to let Stig answer this question. I want to hear what he has to say.
So in terms of using that for your investment approach, the short answer is that you really want to find companies with the lowest possible price to sales. But it's a bit more complicated than that. The first thing is you need to, as a minimum, compare that to other stocks within the industry. And the reason for this is that if you look at companies like in the pharmaceutical business, you will often see gross margins of 90%. And you might see operating margin of 40% for the best companies. So the cost structure is just very different in that industry. And then you can compare that to, say, retail. Walmart, their operating margin is around 4-5%. And both 4% for Walmart and 40% for some pharmaceutical companies, it's good. But it's all within that industry. So it's not a fixed number you can just put in and say, the price to sell should be 1 or it should be 3 or 5, whatever it is you put into your stock screener. It all depends because, of course, pharmaceutical companies, they're priced at a different price to sales ratio. Like if you would get an operating profit of 4%, would you rather pay $1 into that company if it was all priced the same? And then you have growth companies such as, say, Amazon. And you have long seen investors that base the valuation on the top line and the growth of the top line rather than the net profit. Partly because there were no net profit. So it was really hard to base your valuation based on that. But because there was this assumption in the market that, for Amazon, it was all about doing 10x or 100x. And then they can always monetize later. And if you look at even smaller growth companies, that's before they're listed and before anything like that, say that it will go for venture capital funding. That's really when you only look at the top line, because the top line works as a proof of concept that people are willing to pay for the product. So the price to sales you would pay on something like this would be very, very different. So in general, in terms of using that in your screener, in terms of looking at the price to sales in your evaluations of the fundamentals for a stock, I don't think it's a good valuation metric. I don't think any key metrics can stand alone, but price to sales is definitely more like a supporting metric. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.